All right, let's talk about something that a lot of us in finance and business live and breathe, the financial model. Today, we're going to go beyond just the numbers and the formulas. We're asking a really important question. How do we take these incredibly complex spreadsheets from being just fancy calculators and turn them into tools that help us make genuinely smart, strategic decisions? Let's dive in.
You know the feeling, right? You've spent days, maybe even weeks, glued to your screen building out a financial model. And it is a work of art. I mean, every formula links up perfectly, the macros run without a hitch, and the whole thing balances down to the very last cent. By every technical measure, it's a perfect model. It aces every test you could possibly throw at it inside of Excel. But here's the kicker. Does it pass the reality test? And that's the real question, isn't it? A model can be absolutely perfect on a technical level, but in the real world, it could be practically useless. This is the big tension we're digging into today, that gap between a model that works and a model that actually provides strategic value.
So you look at your dashboard, and on paper, everything looks fantastic. All the signs of a good model are there. That internal rate of return, the IRR, it looks amazing. The debt coverage ratios are totally solid, which means, the project can easily pay its bills. You've even built out these comprehensive sensitivity tables to show what happens if things change. Everything checks out. And then it happens, the moment of truth. You present this beautiful model to your boss, or maybe to the client or the investment committee. They look at all your hard work, they nod along, and then they ask the one question your spreadsheet was never designed to answer. This all looks great, but should we actually do this deal? And in that moment, all of a sudden, you've got nothing. That silence, that moment where your analysis hits a wall, that reveals what we call the strategy disconnect. It's the core reason why so many of these technically flawless models end up failing when it matters most, in the boardroom. They're built to answer a completely different question than the one the decision makers are actually wrestling with.
And here it is. This is the heart of the disconnect. Our models are incredible at answering the can we questions. Can we hit a 20% IRR? Can we cover our debt payments if revenue drops? But the boardroom, they're asking should we? What are the real decision factors here, beyond just the numbers? Is this a clear go or a no-go? And at the end of the day, what is your recommendation?
So here's the crucial point. Without that strategic layer, you haven't actually built a decision-making tool. You've just built a very, very sophisticated calculator. It can compute any scenario you throw at it, but it can't tell you which road to take. The validation you need doesn't come from the spreadsheet. It comes from the conversation that the spreadsheet is supposed to inform.
Okay, so how do we fix this? How do we bridge this decision gap between a simple calculation and a confident recommendation? Well, let's move on to the solution. It's a simple, but honestly, an incredibly effective approach called the decision tie framework.
Now, the beauty of this framework is just how simple it is. You start with what you already have, your amazing base financial model. Then, you just add one new tab, a go/no-go summary. On that tab, you list out the most critical decision factors, and not just financial stuff, but the qualitative risks too. Then, you give each one a simple traffic light color, green, yellow, or red. And finally, you wrap it all up by writing a clear, two-sentence recommendation based on that summary.
Now, theory is great and all, but let's see how this thing actually performs in the wild. We're going to look at a real-world example, a huge public-private partnership, or PPP, for a brand new toll road.
So in this scenario, the base financial model was pristine. The traffic projections looked solid, the returns were high, the debt structure was sound. If you were just looking at the quantitative side of things, this project was an absolute slam dunk. It passed every single spreadsheet test with flying colors.
But then, the team applied the decision tie framework. And wow, did the picture change in a hurry. Financial viability, that gets a solid green light, just like the model said. Construction risk, well, it's there, it's manageable, but it's a risk. Let's call it a yellow. But then you get to that third line. Political risk. Turns out there was a major election coming up in year 3, and one of the leading candidates was running on a promise to cancel all toll road projects. And that gets a big, glaring red light.
And that was the game-changing insight the financial model would have completely missed on its own. It was a total blind spot. The numbers could be perfect, but if a new government could just cancel the whole project 3 years down the line, the entire investment was at risk. The political risk wasn't some minor detail. It was a potential deal breaker.
So what was the final outcome? The client shelved the project. They decided the risk was just too high. And notice what happened here. The financial model wasn't wrong. The calculations were 100% correct, but the strategy, which was informed by a much broader set of factors, was simply smarter. This framework likely saved them from a potential disaster. So what this framework really represents is a shift in our whole philosophy. It's about changing the fundamental purpose of our work, moving away from just pure analysis and towards driving decisive action.
It all comes down to this one key takeaway. Numbers don't make decisions. Humans tied to numbers do. Our job isn't just to crank out numbers. It's to provide the context, the story, and the clear recommendation that allows people to make smart, informed decisions. The numbers are the evidence. They aren't the final verdict.
So I'll leave you with this question to think about the next time you're deep in a spreadsheet. Are you building something that just generates more analysis and more what-if scenarios? Or are you building a tool that actually drives action and helps your team make better, smarter decisions? Because that difference is everything. Thanks for tuning in.